Well, good morning and or good evening, traders and friends, market enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down and bring you this very special and also pertinent stock market cycle presentation, which will probably take me about 10 to 15 minutes to work my way through. I will say from the onset of this presentation that I will not be referencing the daily move across the three US market indices which happened during Monday's trading session, nor will I be referencing any of our individual top 12 trade lists. I will do that as at the close on Tuesday. So once we have the first 2 days of this weekly trading session to get through, I will bring you a comprehensive update because I understand we have a lot of active trades and we are also very close to triggering into another plethora of not only individual trades, but also potentially a big long-term put on the Dow Jones Industrial Average. Once, in fact, we close below that level and we see price and momentum start to confirm below a lot of these logical areas. More on that tomorrow, but the reason why I am making this YouTube update is because I stumbled across a very fascinating article about 2 days ago, and it's really the first, convenience for me to sit down and to bring you what exactly encompassed or what was within that exact article. What I am going to do over the next 10 minutes or so is walk through that. However, I'm going to do that in video format and I'm very, very excited. I'm very fascinated because when I saw this, it absolutely blew my hair back, so to speak, and I feel as though it's very important that you are up to date with the same information in terms of stock market cycles which may be presenting itself to us. Again, this is not going to lead us indefinitely, or it's not going to be that decisive factor which says, look, the market's either bullish or bearish. We will use it in conjunction with the daily time frame. Again, as technical swing traders, I just find it, fascinating to add to our arsenal of the bigger picture, the macro picture. Is this a market top, a macro market top? Or in fact, are we just, going through the nitty gritty, the, essential correction after this big move to the upside, which again is going to create a higher high and then ultimately, a higher low and then ultimately a higher high indefinitely. Time will tell, but for the next 10 minutes or so, perhaps make yourself a cup of coffee or a tea, get settled in because I think, or I trust at least, that you are going to find this analysis just as fascinating as I did. Now, I'm going to try and color coordinate this as best as possible. It's really just breaking down time frames and just, projecting them out into the future because right now it's incredible what has happened and what is currently happening given where we are trading at in the year of 2015. We obviously made that high in May, the all-time high on the Dow Jones Industrial Average. Since then, we've stagnated sideways. We've seen that retracement or that correction throughout the month of August. And now we've had to sit through pretty much a very bullish October, but November is starting off quite shaky. Again, before I get into the analysis, you may be asking yourself, well, why is your chart looking a little bit different? Obviously, I used the Trade Navigator software. However, I wasn't able to bring up this much detail using Trade Navigator. If you have a look at the part of the screen, this dates back to the turn of the 20th century. So we've got stock market information pretty much dating back to 1902, maybe even 1901. So we have a lot of information to work with, almost 114, if not 115 years. And this is the best chart that I could find, which really maps it as nicely and as neatly as what I need it to in order to do this analysis or to walk through with you in terms of cycles, which I'm about to do. So let's get into it anyway, and let's talk about time frames. The one which I'm going to start with is the low in 1932. Obviously, everyone is familiar with this story. We had the roaring 1920s, which ultimately ended in the biggest crash year to date or in stock market history at that particular moment in time. Since that low in 1932, the markets themselves, or at least the Dow Jones Industrial Average, it rallied and it continued to rally for decades into the future. In fact, it took until 1966, which is this point over here, until the market itself needed a breather. You are all well aware that markets do not go up indefinitely forever. They go through bull markets, they also go through bear markets, and they also go through sideways markets where the market itself is very stagnant. Now, it's very hard to decipher this in the heat of the moment. It really takes decades to understand this and to get the clearer picture. However, when we have a look at the past and replicate that into the present, it gives us a very good outlook in terms of where the market may be heading to. The reason why this cycle right here, and I'm going to sort of draw this in green, you can see the 2 red points on my chart. Why is this so important? It was the big mega cycle, the first mega cycle, which we've seen right through to the 1960s. Again, this topped out in the year 1966. When we hit the year 1966, the market itself stagnated. It moved sideways. It set up a very predictable type of pattern. It's what we call a broadening top or a bearish megaphone type of pattern in terms of technical analysis, and it looks a little bit like this. When you're in the pattern, so it's very hard to decipher this as I was talking about just before. When you are in the pattern, you still make a series of higher highs, but at the same time, you are still establishing a series of lower lows. Isn't that very interesting? Again, this is 1966, where we made the first initial high, and we moved sideways really until 1982, which is where the trend line connects from the 1932 low, if I can draw it up here. The market itself just simply moves sideways. But within this sideways market moving, or within the sideways moving market, we had both bull markets, and this is primary bull markets, and also primary bearish markets as well, where the market moved downward, and it moved severely downward. The crash which I want to highlight to you is the year 1973 into 1974. Very, very interesting type of market movement, because it looks as though in terms of the broadening top formation which set itself up throughout the 1960s, doesn't this look a little bit similar? What's going on now between, the tech.com bubble, which it moved us up to relative all-time highs in the year 2000. We've had the 2007 bubble as well, which corrected itself. And now we're back up at what may be potentially the top of a new broadening type of pattern, a broadening formation, or what you want to call a megaphone type of pattern. This is where it gets very, very interesting. The bottom of 1932 all the way up to 1966, this accounted for 34 years. All right, remember this down, write this down or remember it. 34 years was the cycle from the bottom little color here in green all the way up to the first or the initial peak in the year 1966. Let me ask you the question, if we use the low in 1932 and if we use the low in 1974, understanding that the market itself moved sideways for the better part of 15 years and the ultimate low was in 1974, wouldn't it be interesting if we use this little cycle low over here as we did in 1932 and started projecting this back up into where we are currently trading? As I said, the first year, or the year that I wrote down, was 34 years, right? I'm just going to put a big 34 up here. This was the 1932 low all the way up to 1966. Well, what happens, okay, if we use the low in 1974, if we add 34 years to 1974, what do we get, give or take? We get the year 2008. Another 34-year cycle, all right? This is just the beginning of what I wanted to speak to you about. So we've got two 34-year cycles which have worked out quite well, right? The initial peak, right? 34 years. If we take this one step further and we understand that this may be a broadening top, or it was a broadening top throughout this specific period, 60s and the 70s, until ultimately we made the bullish trend line in 1982 and the market broke out above its all-time highs and we started the most recent bull market. What happens if we take the 1932 low to the highest high throughout the broadening formation, which I've just referenced? What happens if we don't take the 1966 level, which was 34 years? What happens if we forecast it out and make it through to 1973? 1973 was the peak of this broadening top formation, and this is why the 73 and 74 crash is so important at this particular moment in time, or in terms of this analysis. Now, if we take that, it gives us a yearly time period of not 34 years, but it gives us a 41-year time period. You may be asking yourself, well, what's the difference? We've got 34 years to the initial peak, now we've got 41 years. Well, this is where it gets even more fascinating. Fast forward, if we use 1972 lows again, this was the base of the broadening formation, and we start projecting this further another 41 years. What does that equal? what does that equal? What does 1974, right? I think you're getting the answer, plus 41. I think I've got a 5 here. I've got a 1 if I'm rounding up, and I've got 20. Isn't that interesting? The year 2015, currently where we are trading at. Now, on this chart, the closing print on this chart is 17,832. So we are within about 100 points of where we closed at on Monday. Isn't that very fascinating? 2 cycles in the stock market, according to the broadening top formation or the megaphone pattern, which is shown up in history, and it's shown up in stages throughout a stock market cycle. Both bull markets, but bull markets eventually come to an end. And when they do, you may not understand that you are currently in a period of sideways moving market or sort of a stagnating market where you're getting these really big gyrations up and down, but the overall net movement itself has been pretty much flat. We've endured 2 major crashes. The market is up at all-time highs, but at the same time, we're coming back up into what could potentially be another broadening top type of formation. I've walked through the 34-year cycle low from 1932 all the way up to 1966. I found that incredibly fascinating. And then again, projecting it from the 74, you get 2008. And if you want to go out one further cycle from 32 to the high of the broadening top, you get 41 years. And then if you project that from the 72 low, here we are, May 2015. That is pretty much what I wanted to speak to you about. I do have one more piece of analysis which I can add to this question, but again, I'm not here to fearmonger anyone or to get anyone unsettled or to start panicking whatsoever. If I draw this trend line from about the 82 low, and this is this point right over here where the market finally said, hey, we're going to break out and we're going to trend bullish. If I just project this out into the future, I'm just going to draw this out. This is a very rough sort of extension. I do not have a perfectly linear line. And if I draw this bearish megaphone pattern, as I've done throughout the 1960s and the 70s, you get this point over here, somewhere about 6,000, 7,000, 8,000, as to where this pattern will move if in fact this is a legitimate broadening type of top, which we are currently seeing. Now again, this analysis in and of itself doesn't really give us all that much insight into the daily or the weekly type of outlook for the market. I'm not sitting here saying, look, I'm all out bearish because the market is in a broadening top formation. Please do not misconstrue what I'm saying. These charts can be somewhat ambiguous at times, but it definitely adds to the macro picture and what type of chart or what type of, economic cycle which the markets are currently maybe potentially rotating into. Again, the daily time frame will always lead us in making our individual trade decisions and, of course, our trading plans. I do not defer. I do not diverge from that. I just thought that, hey, I found this fascinating. Is it a really, is it something more than what it is, or is it just a commonality between the two that, hey, it's just sort of worked out this way? Is this random? Is this by chance? Or is this because of a legitimate long-term stock market cycle, which has already shown up in history? That's what I'm trying to sort of, speak to you about right now. Is this pattern which we saw about to replicate here as we move into 2016, maybe into 2017? A lot of economic data suggests that it is, but at the same time, again, I've got a level head. I'm very bifurcated. I'm very neutral in trade setups. And I'm going to let the chart on the daily time frame direct me in my immediate decision making. Again, at this particular moment in time, it is to the downside. The market has gone through a very complacent rally back up very close to its all-time highs, and it really looks as though, as at Monday's trading session, that we may be starting to eke out some form of a lower low on the market. One final piece of analysis between this broadening top and what may be setting up again as at 2015 to date is that the cycle high, let me just bring this up for you right here. The cycle high in 74, let me just try and get my pen drawing tool to work. Whoop, wrong one. Sorry, the 1966 high, which is just here. As we were coming back up into that 66 high, I wish I could zoom in and show you this, but it's really in this red portion of the screen. Just imagine that you can only see to the left of the red line. We had one top here, a second top, And then it looked as though we were coming back up into the all-time high. We pulled back. It looked as though the market itself was going to roll over. And then we had one final push back on up. And the 1966 high just only eked out a higher high relative to... sorry, let me just correct myself. The 66 high, let me just get this right so I don't get anyone confused right now. All the way through to the 73 high, it eked out a little bit of a higher high. And as I compare that through to 08 and 2015, the market itself may pull back a little bit, pushing up just a little bit higher, just and only just, and then the exhaustion. Utter complacency, people buying into all-time highs, expecting the market again to indefinitely rally, will get found out. And instead of buying the dips, as what the media are saying, buy the dip, it's a great opportunity to buy the dip, the market's at a discount. When you look at this chart and you see just how far we've come through the lows in 2009, if we extend that out and we extend the top again, it looks very, very beautiful in terms of technical analysis. It's very, very risky to be complacent in this market and to simply be going out and allocating your portfolio at this particular moment in time, if it is not already allocated, into a bunch of long-term bullish trades. We need some more information. The market itself is overheated. It's overbought. All right. And it's very toppy. It's very, very toppy. So again, just to conclude, the 66 high was just a little bit lower than the 73 high, which led to the 73-74 crash. And as I look at this market right now, the market can pull back and push on up just a little bit higher. But what are the probabilities of something like this setting up again and coming back down to not only the broadening formation bottom, but also this long-term trend line, which is set up since the lows in 32 all the way through to this little point over here in 82, and where we can extend it through to into the future. I'm not going all out. I'm not net bearish at the moment, but hey, I thought it was constructive. I hope you find this information or this presentation somewhat educational, if anything, maybe a little bit fascinating as what I did. But again, it's not going to direct my immediate trading decisions. I'm letting the daily chart dictate to me what the market or where the market wants to go. But hey, anything that can help us maybe put this market into perspective as to where market cycles are ending or long-term bull markets are ending, and potentially giving you the opportunity to hedge in bearish positions, or at least have somewhat of an understanding of what may happen in 2016, maybe 2017. Time's always hard in terms of the daily time frame, but definitely what may be on the immediate horizon. I hope you found this very, very beneficial and exciting and fascinating, just as what I have done. So outside of that, it has only gone for 18 minutes, so a little bit over time. It's not as long as what some of my updates are. I mean, I put one out last week at 28 minutes, but find it a little bit constructive. Don't go out there and say, hey, I'm all out bearish, I'm a mega bear whatsoever. I'm simply not. I'm just stating facts for you, which we can apply to the current marketplace. Traders and friends, have a fantastic Tuesday trading. We have a lot of open positions that I'm excited to see, and also the opportunity for those DIA puts to finally trigger. Outside of that, I'll be back with you tomorrow or at the end of Tuesday's trading session to bring you the individual trade update. Have a fantastic day, everyone, no matter where you are located around the world. It is James signing off on behalf of Pivot Point Trading. All the best. Goodbye.